Hi there, I'm Murray Dawes and I'm editor of Pivot Trader, and today I want to cover a bit of ground on some theory that I've been writing about in my Saturday articles, Traders Corner articles, and I discuss a lot of different things like trading psychology, but have been covering off some of my theory on the technical analysis side of things, and it's much easier to use show and tell rather than writing about technical analysis, which can seem pretty dry, I must admit. So I just wanted to cover off some of the things I wrote about in the last few weeks and then show you some examples with some real trading that's been going on at Pivot Trader. So what I wrote about on the weekend last Saturday, you can look up the article. I was talking about how prices oscillate around a key level, the POC, point of control, and how we have a lot of mean reversion that occurs, which you can use to set yourself up into strong positions. And then ultimately the market then decides, to take off in whatever direction. But understanding the process of how these distributions form and what the best approach to trading them is really important from the point of view of also not getting caught out by them, so that you're not buying, for example, up here, which is where a lot of people end up buying, thinking there's a breakout to the upside, and all of a sudden they're shaken out, and then they look back a few months later and prices have taken off to the upside and they scream. So what I said on the weekend was that there is a relationship between the size of the false break. So if we have a range set up, once we've had a trend to the upside, for example, we have a reaction against that trend, which is quite large, which slows down the trend, and then the market goes into a series of false breakouts. Where you have traders trying to buy the breakout, getting shaken out, prices moving back to the POC, and then if prices break below the extremity of the range below, the people who have been buying in this area will be stopping out, and people who are bearish will be getting short, and then all of a sudden things turn back up again, and we see a squeeze back to that POC. And the size of the false break, as I was saying, looking 25% outside the range and 61.8% outside the range is where you find very often the key areas where prices finally peter out, going in that direction, turn around and head back to the point of control. So you can use that knowledge to set yourself up in some great trades. So, for example, if that range, the reaction against the trend was $10, let's say, that's a nice looking $10, the area 25% above the range would be, of course, $2.50 above that high. And the area 61.8% would be $6.18 above that high. And below, same thing. $2.50 below would be a spot where you'd be looking for reversals, and 61 or $6.18 below the low of that range would be the spot where I'd expect there to be a high probability of reversals leading to a move back to the POC. And really that's all you need to know, because you can use that knowledge to take part profit. And once you've taken your part profit, you can then set yourself up into a position where you will either break even or make money. And this is the thing I want to show you in some examples. And the other thing to point out is those buy and sell zones that I've been talking about, of how prices reverse within a range at specific levels, can also be used in waves in a trend. And the retracement levels I use are 75% to 87.5%, so very large retracements. So if we have a move to the upside, massive move, let's say again it's $10, the area where I'm most interested in finding a reversal back to the upside, if it is trending, is a $7.50 retracement to $8.75. So that's a large retracement of that previous wave, which shakes lots of people out. And if you then get good reversals from there, you can often join trends at really powerful spots. The buy and sell zones, 12.5% to 25% and 75% to 87.5%. Now let's have a look at some live examples of these ideas. Now this is a monthly chart of 9 entertainment holdings, and we're looking at years of data going back to 2014. Now if we look at how prices are moving, there are not only massive waves to the upside where prices were trending for quite a long time there, for a year and a half or so, but also in the even bigger picture, I can look at the whole range here and see that as a distribution forming with a series of false breaks where prices break out, get people long and bullish, and then we have the shakeout. Prices move back to that POC, the point of control of the range. And I also look for these buy and sell zones of the range. So this is that, the 12.5% to 25% and the 75 to 87.5% area of retracement of the wave. And that is the area where I'm expecting to see within the range potential reversals back towards the point of control. And also here you can see prices nearly getting into that area and then turning back to the POC. So those areas are interesting as far as looking for reversals. So during the crash, prices plummeted and actually had a false break of the low of the range, you can see there, and then started turning back up. And I got long for Pivot Trader members at $1.17. So around this level, we bought the stock. And what is the target? Well, the target is heading back to the POC, that point of control, which is where there's a high probability of a move to that area, but then, it could have turned back down from there. And so we took part profit, selling some of our stock at that POC, which left us with a position which had an average entry price below the low of the whole structure. So after we'd bought the stock, taken part profit at the point of control, our average entry price was below the low of the range, so below the lowest price ever traded. If prices did turn back down and break below that low, we would break even on the trade, so we wouldn't lose any of our initial capital. So it wasn't long while we were in a position where we were risking our capital. It was quite a short amount of time before it hit that POC. We took part profit and then really had a free option to see what was coming next. And you can see prices ultimately did take off to the upside. And now we're well in the money on that position very quickly, up over 100%. So using that theory of the distributions, how they form, the moves to the point of control, where the buy and sell zones are, how prices change direction can all be used to create real trades in the market where you're not risking too much of your money for too long, and then you get to create free options. So another example would be Linus, where we bought that stock. Here is a monthly chart of Linus, and what can we see here? Can you start to see these false breaks that occur, the range that gets set up? And if I put my range on here, everything starts to jump out, where we have, as I said, a trend to the upside. We have the large reaction. We then have the false breaks where people get bullish and they get shaken out. People get shaken out to the downside as well. And we have prices revisiting the point of control of that range over and over. So we bought around $2.10, I think, $2.15, around this area here, because I wanted to wait until we saw the monthly buy pivot, which is when prices closed on a monthly basis here above the high of that lowest price candle in this sell-off on a monthly basis. So that's the first sign that things are turning back up. So I then took part profit on the way up. So we now again have put ourselves in a position where the only outcome will be breaking even or making money from this point on. And another thing to look at, as I described, looking at waves to the upside in trends, and the fact that these ranges and the buy and sell zones work on waves in a trend. So you can see here that initial wave to the upside a few years ago in Linus out of the big sell-off, and prices then sold off, shaking traders out into that buy zone area, the 75 to 87.5% retracement before turning back up. And if we look at the whole range to the upside, this whole rally over a few years, and if we look at where prices pulled back to, you can see again the buy zone of the whole wave higher. We had a massive shakeout during the crash, prices coming back to a 75% retracement before turning back up. So you can ultimately use multiple things to confirm where important support should be. And just another final point, look at where prices reversed. We have this reaction against the trend, and the area that I was pointing out is at 25% and 61.8% outside the range. So there's the 25% outside the range, and prices pretty much reversing bang on that level, 25% below the range. So lots of stoppies have gone off, and then the buying has stepped in. So using these ideas, even though they may sound simple, once you start to understand the process, you can start to see really powerful entry points. So if we move on to red bubble, for example, and we just look at it from the point of view of the range that we've been talking about. If I really go in and look at this closely, we can see for years Redbubble was pretty much trading around this initial range from 2016-17, and this is the monthly chart. It broke out to the upside. Where was the resistance? At that 61.8% level outside the range. Then prices fell back to the point of control again. Then we've got these key areas inside the range, the buy and sell zone within the range, which you can see there, and prices bouncing off that, heading back to the POC. So lots of work done for years. We had another rally and lots of resistance at that 61.8% level outside the range. Prices heading back to the point of control again. Then the crash pushed it to 25% below the range. Again, prices turning back up and heading back towards that POC once more. And we bought the stock at 95 cents as prices were turning back up. Took part profit up in the sell zone of the range, because that is a high risk spot where prices could have turned back down from. and then took part profit on another third of the position, up at, I think, around $3, a bit higher than $3. And then all of a sudden, only a few months later, prices were up at $6, having bought the stock at 95 cents only months earlier, all based on the theory of how distributions form, of how prices oscillate around the point of control, taking part profit to get to a position where you have a free option to see what's coming next, and then sit back and enjoy the ride without lots of stress. So hopefully that has explained a few things for you if you've been reading the articles I've been sending out on the Saturday. And I'll continue to teach you more about these structures every Saturday. So look out for my articles there. Cheers.